One of the best ways to cut through market noise is to let a line do the talking. Let me show you how moving averages can help you follow trends, time entries, and as well as avoid emotional decisions. Hi, I am Pranav VK, an NISM-certified trader and trainer and your guide at Stockshaala by Kotak Securities. In the last video, we covered what moving averages are, and in this video, let's understand how to use them to their best. So let's start with spotting the trend. The first thing you want to do is identify what is the direction in which the market is moving in. And moving averages is going to help you do just that. If the moving average is sloping up and the price is above that slope, then possibly you're in an uptrend. But whereas if the moving average is sloping downwards and if the price is below that, then that's when you're in a downtrend. It filters out all the small ups and downs and shows you the bigger direction. Let's take an example of the Nifty 50 chart to understand this better. Here, as you can see, in the Nifty 50 chart, I have taken the 1-day time frame, which means each candlestick represents a single day. You can also see a blue line here, which represents the 50-day moving average. The price has been volatile and moving up and down continuously, but you can see that the line has been smoothened out using the 50-day moving average. So once you have entered into a trade, it helps you stay in that specific trade for a longer period of time without worrying about any emotional decisions. Trends don't move in a straight line, they breathe, which means a pullback is where you get a low risk opportunity to enter. In a healthy trend, price generally comes back to the 20 moving average or the 50 moving average and bounces back before continuing. So you have to look for a clean pullback or sometimes a bounce near the moving average, a strong bullish confirmation near the moving average. This setup gives you a tight stop loss and a great reward potential. Now let me show you all of these points on the Nifty 50 chart once again. As you can see in the chart here, we have the 50-day moving average, and like I mentioned, a healthy trend will always keep bouncing back at the moving average, and we can see multiple bounces at this specific moving average as well. And we also have one specific example here where we have a strong candle closing above the moving average, after which it has exploded on the upside. So this shows how useful moving averages are in your trading journey. Let's understand how we can use moving averages as dynamic support and resistances. Unlike horizontal support and resistances, moving averages move with price, which makes them dynamic. In uptrends, they act like a rising floor, whereas in downtrends, they act like falling ceiling. The markets respects them, especially the 20, 50 as well as the 200 moving averages. Let me show you this with an example on the real charts. Here I have taken the example of Thyrocare on a 1-day time frame, and I have taken the 20 moving average as an example. You can see as the market goes up, the moving average is also moving higher and higher, and you can see it tends to take support at this moving average level. But once the market has broken down from this specific 20 moving average level, it started to act like a resistance, and you can see the continuous resistance of this price and the price falling below it. Here are 3 clean ways to use moving averages for your entries. Here is the first best way to use moving averages for your entries. Using a pullback of the moving average plus a confirmation candle. This is one of the most reliable setups, wherein the price comes and touches the moving average and then forms a very good candle, because of which you can take an entry at that specific level. Here is the second way for you to use moving averages for your entries. Wait for a breakout from a specific 200 moving average or a 50 moving average. The price goes above the breakout region and then retests back to the moving average level. That is a cue for you to take an entry. The third one is a crossover. It is mostly used for trend confirmation more than an entry. When a short-term moving average crosses the longer one, it generally confirms momentum. but don't use this solely for your entries because it often comes late. Here is an example of a crossover on Tejas Networks. On the chart, we have taken the 1-day time frame candlestick chart. The blue line represents the 50-day moving average, whereas the white line represents the 20-day moving average. As and when you can see that the white line crosses the blue line, that's a crossover confirming that the trend is bearish. And after that crossover, you can see the trend has continuously been on the downtrend. Here is a classic example of a pullback entry along with a confirmation candle. Here again in Thyrocare Tech Limited, on the 1-day time frame, you can see on the 20-day moving average, we see there was a pullback just touching the specific moving average and rebounding back, after which you can take the entry. Now you must be wondering, Pranav, why does this work? The answer is very simple. It's not just you, but a lot of institutions as well as retail traders track the same thing and use this data. So when there is a crossover or a pullback, it's not just coincidence, but it's a reaction to the specific movement. Now this works because of mass psychology, and you should use this to your advantage. While moving averages are very useful and powerful for a trader, you should also be aware of when not to use them. Moving averages work beautifully well in trending markets, whereas they are not so good in choppy or sideways markets. So it is better for you to avoid during sideways markets. In sideways markets, moving averages will give you false signals, whipsaws and headaches. And that's exactly why you should not use them in the sideways markets. So let's wrap it up. Use moving average slope plus price position to identify the trend. Wait for pullbacks in trending markets to get entries. You can also watch for confirmation candles for your entries. Use dynamic bounce zones, not rigid lines. And don't rely on moving averages during sideways markets. And don't treat crossovers like instant buy or sell signals, as often they come later. Trust the trend, but let the moving averages guide your entry. I am Pranav VK, and I'm going to see you in the next video. In the next video, we're going to explore two of the most dramatic terms in technical analysis, the golden cross as well as the death cross. Are they as effective as they sound? Stay tuned to find out. Like this video if it gave you practical clarity, and share it with your trading circle. And watch Kotak Stockshaala if you want to be a smarter, sharper and a profitable trader.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.